What we're going to talk about now is TRID. TRID stands for TILA RESPA Integrated Disclosures. TILA RESPA Integrated Disclosures. What it is when the CFPB started looking over everything, they looked at some of the TILA documents, they looked at some of the RESPA documents, and they noticed that there was a lot of documents, or disclosures we should say, that borrowers had to review and sign. And a lot of the borrowers were confused. The TILA documents said some of the same thing as the RESPA documents and vice versa. So what the CFPB did is that they integrated some of those disclosures. So that's why it's called TRID, TILA RESPA Integrated Disclosures. They took some of the TILA disclosures, then they took some of the RESPA disclosures, and they combined them, and then they eliminated others. TILA RESPA Integrated Disclosures. So we're going to talk a little bit about that. Now, the whole purpose of TRID is designed to help consumers become more informed shoppers. As I said, borrowers were getting confused. They looked at RESPA disclosures and they said some of the same things as TILA disclosures, and it was a lot of overlapping. So the whole purpose of TRID was to help consumers understand what their options were, but also to avoid any surprises at closing. Sometimes borrowers would get to the end and they look and see what their closing costs were or what their fees were, and they were totally shocked because it wasn't really discussed with them in the beginning. So the purpose of TRID, one of them, was to help borrowers choose the best option for them, but also to avoid any surprisings that came up at closing. Now, most of the TRID disclosures deal with purchase and refinance transactions. One of the things that you're going to notice, and one of the changes that TRID made, was in purchases and refinances, the good faith estimate has now been changed to the loan estimate. So if you're doing a purchase or a refi, you won't get a GFE, a good faith estimate. That has now been replaced with the LE, the loan estimate. And as it relates to the HUD, you won't get a HUD anymore if it's a purchase or a refinance. You'll get what's called a closing disclosure. The HUD has been replaced by the closing disclosure when it comes to dealing with purchase transactions and refinance transactions. Now keep in mind that these forms did not go away. There's still a such thing as a HUD or a GFE. They're just not used in purchases and refinance. They're used in other forms of mortgages like reverse mortgages or construction mortgages or mobile homes. But for the purposes of the exam, there's no more GFE when dealing with purchase and refinance. There's the LE, the loan estimate. And there's no more HUD. You're going to be dealing with the CD, the closing disclosure. And moving forward, you need to know what's considered a complete application so that you'll know when some of these disclosures actually have to be given out. So you have to know what's considered a complete application. According to the CFPB, these are the 6 items that make up a complete application. And you have to know all 6 because they're going to ask you questions. Which of the following is considered a complete application? Which of the following is not considered a complete application? And you need to know that these are the 6 items that make up a complete application. And let's talk about number 5 there where it says address of subject property. They're going to ask you what's okay to be there and what's not okay to be there. So here we go. What's okay to be put there? Where it says address of subject property. If it's a refinance, of course you know the address. You put it there. But what if it's a purchase and you're just getting a pre-approval and you don't have the address? You can put there TBD, to be determined. You can also put there UNK, unknown. But what you can never, ever, ever put there, and you will be tested on this, is NA, not applicable. That's a one that you cannot use there, because how can it be NA? So either you have the address there, you have TBD, to be determined, UNK, unknown, but never, ever, ever will you have NA. So these are the 6 items that make up a complete application. And the reason why that's important is because if the creditor, the bank, get these 6 items, they have to give out what's called the initial disclosures. Very important, the initial disclosures. I'm going to talk in a little bit about what the initial disclosures are, but you need to know when the borrower must get the initial disclosures. They must get the initial disclosures when the bank, the creditor, gets a complete application, which only consists of these 6 items, and there are only 2 exceptions. So of course you want to know the exceptions so you can pass the exam. One exception is unless the applicant withdraws the application. They change their mind. The other exception is if the lender turned them down before the 3-day period. So the question would be, when would the borrower get the initial disclosures? Initial disclosures. They will get the initial disclosures at or within 3 days of the application, unless the applicant withdraws the application within the first 3 days or the lender turns it down within the first 3 days. Those are the only exceptions to the rule. What are the exceptions to when the borrower would not receive the initial disclosures? If the applicant withdraws the application within the first 3 days or the lender turns it down within the first 3 days, they won't get the initial disclosures. Otherwise, the creditor, the bank, must give them the initial disclosures at or within 3 days of the application. So on the next slide, I'm going to go over for you what the initial disclosures are. So before I go over this chart, which I call it the TRID timeline chart, a few things I want to make sure that you take note of. The first thing I want you to write down about this chart is that RESPA deals with timing. Again, RESPA deals with timing. RESPA is more concerned about when you get certain documents versus what documents you get. RESPA deals with timing. And according to RESPA, there are 4 different time frames when certain disclosures have to be given out. There is at or within 3 days of the application. That's the first one. Before settlement, which you should make a note, before settlement means before doc signing. At settlement, make yourself a note, at signing means at the actual doc signing. And then even after settlement, that means docs have been signed, the loan is going on and on and on. After settlement, there are certain things that RESPA says that the borrower still must get disclosures on. RESPA deals with timing, not so much what they have to get, but when it has to be given out. 4 different time frames: at or within 3 days of the application, before settlement, meaning before doc signing, at settlement, meaning at the doc signing, and even afterwards, there's still certain items that RESPA says the borrower must get. So let's talk about what they must get at or within 3 days of the application. They have to get what's called the initial disclosures. Initial disclosures. And if you remember, when we talked about this page, I told you when they would have to get the initial disclosures. The borrower will get the initial disclosures at or within 3 days of the application. Who says so? RESPA. RESPA says they get the initial disclosures at or within 3 days of the application. Now, what are the initial disclosures? You need to know that. They're going to ask you, which of the following is one of the initial disclosures? Which of the following is not one of the initial disclosures? If you know all 4 of the initial disclosures, then they can't trick you. So here we go. Here are the 4 initial disclosures. Disclosure number 1, initial disclosure, is the home loan toolkit. Sometimes it's called the Know Before You Owe booklet. The home loan toolkit, Know Before You Owe booklet. It's for purchases only. It is an initial disclosure that they get when, at or within 3 days of the application, and they get it if they're doing a purchase transaction. So the Home Loan Toolkit, or what they may call the Know Before You Owe booklet, is an initial disclosure that they get at or within 3 days of the application. Another initial disclosure is the loan estimate. The loan estimate. Now remember I told you that the loan estimate was formerly the GFE, the good faith estimate. Well, they don't use the good faith estimate in purchases and refinances. They use the loan estimate. Now notice also, I have it in red. So pay attention to what I'm saying here. That's because it's a TILA document. They're going to ask you about which disclosures are RESPA disclosures, which disclosures are TILA disclosures. The loan estimate is actually a TILA document, but it's on this sheet because RESPA says when they have to get it, because RESPA deals with timing. So let me try to make that clear for you. If they were to ask you what law or what regulation says that they must get the loan estimate, the answer would be TILA. It's a TILA document. But if they ask you what law or what regulation said they must get the loan estimate at or within 3 days of the application, then the answer is RESPA, because RESPA deals with timing. Not so much what they have to get, but when they have to get it. Who says they have to get a loan estimate? TILA. Who says they have to get the loan estimate at or within 3 days of the application? RESPA, because RESPA deals with timing. Now, the other initial disclosure is the mortgage servicing disclosure statement. And you notice I have here underlined the word servicing. The mortgage servicing disclosure statement tells the lender's intent. Write that word down. The lender's intent as to whether or not they're going to service the loan themselves, meaning collect the payments for the taxes and insurance, or if they're going to hire a third party to do the servicing. For example, when I started my loan with, on my home, it was with IndyMac. But they told me that the servicing may in the future go to someone else. And eventually they changed it to Aquin and to SLS and a few other servicers. But the mortgage servicing disclosure statement tells their intent on whether they continue or they plan to service the loan themselves, or if they're going to hire another company in the future to do the servicing. For example, we're Bank of America. We're going to fund your loan and we're going to service it as well for the entire term. You're going to always make your payments to us, Bank of America. Or they can say, we're Bank of America. We're going to fund your loan, but we reserve the right to send the servicing to a third party. We might not. Could be in 5 years, it could be in 10 years, it could be never. But the mortgage servicing disclosure statement tells their intent. They have to let you know what their intentions are at or within 3 days of the application. We're going to fund it and keep it forever, or we're going to fund it, but we're reserving the right to let someone else in the future service it. So the mortgage servicing disclosure statement tells the lender's intent regarding the servicing of the loan. Servicing is just taking the payments and paying the taxes and insurance. The other one is a list of HUD counselors. That's one of the initial disclosures, a list of HUD counselors. They have to give them that at or within the first 3 days of the application. Because what happened was, in the past, borrowers were confused. They said that their real estate agent was confusing them, their loan officer was confusing them, escrow was confusing them. They didn't know who to trust. So now the CFPB says that they have to be provided with a list of HUD counselors within the first 3 days of the application, so that they have questions, they have a third party that they can go to that has nothing to do with the transaction that they can ask questions to. So these are the initial disclosures. When do they get them? At or within 3 days of the application. The next phase that RESPA says that they get certain disclosures is before settlement. Again, before settlement simply means before they sign docs. They get the affiliate business arrangement disclosure. If you are referring them to a business that you have part ownership in, you have to disclose it. If you are referring them to a business that you have part ownership in, you have to disclose it. For example, you're doing a loan for me and then you refer me to a roofing company. If you own a part of that roofing company, you should let me know. I should know that because now you're going to be making money off of me in more than one way. That is called an affiliate business arrangement disclosure. And the question on the exam is, if you own more than what percent are you required to disclose it? Or people are picking 10. Well, if I own 10%, I have to disclose it. No. If you own more than 1% of a business that you're trying to get me to use, you have to disclose it. So remember, 1%, not 10%. And the other disclosure that has to be given out before doc signing is the closing disclosure. The closing disclosure. Remember I told you the closing disclosure used to be called the HUD. And when it was the HUD, the bar had the right to get it one day before closing. Well, not anymore. Now it's called the closing disclosure. And when does the bar get it? The bar gets it 3 days prior. 3 days prior to doc signing. They use the words loan consummation, loan settlement, doc signing interchangeably. Now notice it's in red. That's because it's a TILA document. RESPA just says when they have to get it. So what law says they must get a closing disclosure? TILA. What law says they must get a closing disclosure 3 days prior to doc signing? And if you notice again, they even get it again at the doc signing? RESPA. Because RESPA deals with timing. Who says they have to get the closing disclosure? TILA. Who says that they get it 3 days prior to doc signing and again at doc signing? RESPA. Again, because RESPA deals with timing. RESPA says that they also must get what's called the initial escrow statement. That's just a statement telling them how much their taxes and insurance are. They get the initial escrow statement at settlement, meaning at doc signing. And then after settlement, docs have been signed, the loan is closed, there's some things that RESPA requires that they still have to get. The first one we talked about in RESPA Section 10, the annual escrow statement. If their taxes and insurance is impounded. Again, if their taxes and insurance is impounded, every year they get an annual escrow statement, letting them know this is what we took with your payment to pay your taxes and insurance. This is when we paid it. And they also get what's called the servicing transfer statement. Notice that I underlined the word transfer. The servicing transfer statement. Up here, in the first 3 days, we said they told you their intent. We may not, we don't know. We might sell the servicing of your loans. Someone else may be making your payments. But down here, after settlement, the servicing transfer statement is when they actually do it. We sold your loan. The servicing of your loan. Don't make your payments to us anymore. Start making them over here to SLS or Aquin or whatever some other lender is. They also call it the goodbye letter. Goodbye. Don't make your payments to us anymore. Start making them over here to this new servicer. The question on the exam is going to be, when would the borrower get the servicing transfer statement? Or when would the borrower get the goodbye letter? They're supposed to get it 15 days prior to the transfer. So they'll know where to make their payments. So when would the borrower get the transfer statement, service transfer statement, or the goodbye letter? 15 days prior to transfer. So they'll know where to make their new payment. And then the borrower is not penalized. They have a grace period for the first 60 days. Well, what does that mean? Well, what if they didn't open their mail and they didn't know that it was transferred to a new lender and they sent the payment to the old lender? That's going to fly for 60 days. They won't have any penalty, any late fee or whatever. The lenders will fix it amongst themselves for the first 60 days. But after 60 days, you need to have gotten that together and make your payment to the correct lender. So they have a 60-day grace period. Again, this is the TRID timeline chart. The items in red are required by RESPA. Are required by TILA, not RESPA. So you'll notice here I have RESPA, TILA, RESPA, TILA. If they ask you what law says the borrower must get the home loan toolkit, it's RESPA. If they ask you what law says the borrower must get the loan estimate, TILA. RESPA deals with timing, when they have to get it. So the ones I have in the red are TILA documents, the loan estimate and the closing disclosure. All the other documents here, disclosures here, are RESPA. RESPA disclosures. Who says they have to get the annual escrow statement? RESPA. Who says they have to get the servicing transfer statement? RESPA. Who says they have to get a list of HUD counselors? RESPA. But who says they have to get the loan estimate and the closing disclosure? TILA. Those are TILA documents. TILA says that they have to get them. RESPA just says when they have to get them. Again, RESPA deals with timing. All right, guys. See you in the next training.